VC in dental is a strong performing investment modality. And that's largely because of the way in which we source deals and diligence them, as well as how we support them and lead them to growth and exit opportunities.
Welcome to another episode of the Orthopreneurs podcast. Today, we have a returning champion, Jeremy Krell from Revere Partners. Jeremy, welcome.
Thank you, Glenn. It's a pleasure to be here again. Really like the podcast and looking forward to the follow-up conversation.
For everybody out there, I'm going to give you some insight, or Jeremy's going to give you some insight into a world you may not know much about. Now, he was on a previous podcast, and so a lot of the real details and nuts and bolts about what we're going to talk about are found there. So you should definitely go listen and watch that podcast episode on Orthopreneurs. But today, I want to take the conversation to the next level because we're going to be talking about VC or venture capital money. And we're going to talk about, again, Revere and what Revere is and who Jeremy is. But as orthodontists and others out there who are listening, you don't get the opportunity very often to invest in venture capital money. And, there's alternative investments out there. There are some that are very, very risky. There are some that are very, very conservative. And we'll talk a little bit with Jeremy about where this kind of falls in that sort of spectrum. And so let's start here, Jeremy, just as a matter of background. I know that you're a dentist by training. You're also, I believe, an MBA by training, if I'm not mistaken. If you want to tell everybody how you got interested in what you do now, and I guess start by telling people what it is you do now and how you got interested in it.
Today, I'm the managing partner and founder of Revere Partners, which is the first and only venture capital fund that focuses on dental technology investing. And the way that I got interested in this field is because I'm a startup guy. I'm a builder, an operator by heart and by trade. I started in technology before dental, and then into health technology at Oscar Health Insurance, leading a department there. And then to Quip, so into dental technology, leading the professional services side of the business, and ultimately saw that there was no organization or centralization or standardization around investing into dental technology. So just as my previous startup background gave me the experience to do, I started a new fund that focuses on dental technology investing.
How long ago did that start?
Revere has been alive for 3.25 years now.
So 3.25 years. And so in the lifespan of a venture capital fund, I know that private equity, and we've talked about private equity in the past with other guests, private equity usually looks at a 4 or 5 year window. Usually 5 years is kind of like the window they typically look at for investments, right? They'll find a company or a pension fund will invest a ton of money with them, and then they'll take that money and invest it with the idea that they want to get it back to the investor within about 5 years. And if you don't mind, I'm going to go off here just for a second, Jeremy, and just explain to people about private equity. And that when private equity has your money and you give them, say, $100,000 or $25,000, or it's going to be hard to get into a private equity fund with $25,000. But let's just say you had $150,000, $200,000, $500,000, and you put it into private equity. They're going to take that capital and put it to use. And you will get your money back when they're ready to give it back. Now, you can get some great returns, but it isn't until one of the companies in which they've invested in exits that they take that money and potentially give it back to you or hold it until there's a different closing. How does venture capital work in terms of, how does it work in terms of giving money? And specifically, you can talk about Revere. How does it work in terms of people who want to invest? And then how do they get their money back?
With Revere, we've structured the fund to be an open fund, meaning investors can come and invest in Revere at any point in time. We allow them in essentially on a quarterly cohort basis. Most venture funds open, raise capital, and close the fund. You cannot get in until they open up the next fund. So we made that characteristic and sort of distinguishing difference from the very beginning because we knew that this would become more known and understood within dental and dental technology. So it is an open fund. When a new investor comes in, they come in on what we call a look forward basis, meaning they will then have their pro rata share, their ownership share of the startups going forward that they are involved in investing during. So if they come in quarter 8, 9, 10, and 11, they will have their upside of the startups invested in during those specific quarters. And that gives us ultimate flexibility to be able to accommodate investors on their level, coming in when they're ready to come in and coming in at the amount of capital that they're ready to come in on. So we do leave the amount of capital up to the investor. Typical dentist, orthodontist, or dental industry executive, they started around $25,000 to $50,000 over 4 to 6 quarters, meaning each of those quarters they contribute $25,000 to $50,000. So they're somewhere between about $100,000 and $250,000 when they start with us, right? And then it is a quarterly subscription. Our minimum is 4 quarters, whatever number you choose to invest, and then it can go up to 12 quarters. And then once your term has completed, like any other subscription, you can increase, decrease, stay the same, cancel, penalty free. It's really meant to be an ongoing basis if you want it to be, and it's meant to really offer you a diversification opportunity within your portfolio.
Let's just say average person out there invests $25,000 for 4 quarters. They commit to 4 quarters, so they've invested $100,000. And that way, market goes up, market goes down. Maybe you invested in this company, maybe you invested in that company. You've diversified their $100,000 by having them invest over 4 quarters. How do they get actually paid back? And when does that typically happen?
That's right. So they get paid back when the company has an exit or liquidity event. So in any of the companies in any of the quarters that they're invested in, right? So depending on the type of technology, and we diversify our portfolio, they do tend to exit on different timelines, where pure software, for example, or fintech, that might be closer to 3 to 5, 3 to 6 years. You might be looking at something on average like consumer products. Those maybe take 4 to 6, 4 to 7 years. Right, you may be looking at something like biotech, devices, therapeutics, pharma. Those take more like 5 to 10 years, right? So it really depends on the individual technology, its profile, its stage. We most often invest in what we call the Series A stage, meaning these companies are commercially available, they're FDA approved, they don't only have revenue, but they are growing significantly month over month, quarter over quarter. They are either profitable or have a clear pathway to profitability. That really describes the majority of the startups that we invest in. And on average, what the return profiles look like. Can there be outliers? There sure can. But that is the typical, sort of average of the portfolio. As soon as one of those companies invest through our digital investor portal, you're automatically paid back as an investor. So if you're continuing to do this type of investment over time, you will continuously start to receive checks back as these companies positively exit.
I'm investing today. You happen to make an investment next week in a blank financial technology company, right? Some sort of fintech. I've invested for 4 quarters at this point, but because I was there when that company was invested in, now when that company goes to the next level, that's when I get mine because I was invested. People who invest next month or next quarter weren't a part of that company. So as a result, when that company goes big or pops, they don't get anything from it, correct?
That's right. So as long as we do it on a quarterly basis, so as long as you come in during the quarter, you'll have your pro rata share of anything in that quarter. And then going forward, as long as you're in the quarter, you will have the upside. But things before you started to invest, things after, if you decide to stop investing, you wouldn't have the direct upside of any of those. That said, there are some sort of pay it forward benefits here if we've previously invested in the company and we achieved some, really good terms for the next round, and you were invested in the fund when we made that second investment, for example, in a company, you might have benefited off the fact that we did some work with that company and invested in that company previously. But generally speaking, you're in it only if you're in the fund that quarter.
You're in it if you're in it.
Everybody that flexibility. You're in it, you're in it.
Yeah. And so historically, when people talk about venture capital, I know we talked about it in the last podcast, but real quickly, could you just explain to people what is the difference between, say, buying stocks, right? You buy stocks or mutual funds in a company, Standard & Poor's, right? Whatever you're buying, and private equity and venture capital, right? Because those are 3 or 4 very different things. Most people are aware of stocks and mutual funds, so you don't have to get too much into those. But what is venture capital? What is private equity? And how do they differ?
Yeah, and I'll even add one more in there, because outside of Revere, which is dental specific venture capital, right? There's also just other venture capital, right? You might be invested in, say, in a general tech fund.
Right.
for example. So I'll add in that comparison. So all these work differently. First of all, a key difference is with Revere compared to those other three is your money's going back into the industry, right? That may or may not be the case if the PE you're investing in is also invested in dentistry, then sure, you can make the argument it's going back into dentistry, but you are being diversified within dentistry and the money is going back into dentistry if you're invested in Revere. So that's one thing to kind of keep in mind. Another thing is really kind of the playbook, right? The S&P, the public markets and public securities, they're really at the behest of public market forces. The stock market goes up, it goes down, valuations change on a day-to-day basis. There's a whole number of externalities that we've seen really affect those markets, right? So you're dealing with day-to-day fluctuations there that have to really be monitored, by somebody managing your portfolio. It's a different style of investment, and there's multiple levels of risk depending on what you choose, from CDs and mutual funds being, sort of towards the safer end, and say we're investing in cryptocurrencies, right? Would be maybe the most in risky thing these days that perhaps you could do in that vein. Then you really have private equity. They're making fewer overall investments. They're much, much, much larger assets and assets under management and investments as a whole. The structure in which they invest is this leveraged type structure, leveraged buyout you hear frequently. And so, from a more lay perspective, they really have to squeeze each investment to ensure that they get something out of it, right? And doing that takes resources, and you may or may not have really, really big wins out of it, right? You typically will get something positive out of each investment that they make, but it's not necessarily a force multiplier, because it's essential for their model that they get something out of everything. With venture capital, they play a slightly different playbook, right? Of course, with Revere, we want every single company to succeed, and we have a large number of strategic ways in which we scale and help to exit these companies. And being in the industry the size that it is helps us to be able to do that. But overall, with out of every, say, 10 companies in venture capital that a fund invests in, right? If you have 2 or 3 big winners out of those 10, that easily will carry your investments across the other 7, right? And then you have, somewhere in the middle returns over 4 or 5 of them. And then say you have 1 or 2 that are losers, right? They don't return. This can be a very successful investment stack across those 10 companies, seeing numbers and returns far larger than your investments in any of the other types of investment modalities that we've discussed here. So Revere's done a little bit of research on this, and we've put together the numbers. If you carry out over 3 years, I think we did 2019 to 2022, right? We did our investment portfolio versus just other Series A venture capital funds versus the S&P and versus private equity. Key takeaways: private equity is a good investment too, right? But it turns out that VC and dental is the highest performer of those 4 on the average. And what you'll see is that over the course of those 3 years, if you put in $100K to each one of those in 2019, and in 2022 you measured your outtake, you would have an $85K differential on the average between the lowest performer, the S&P in this case, and the higher performer, Revere's portfolio.
Can you say that one more time?
Yeah, so you'll see among those 4 types of investments, Revere VC in dental versus VC in general versus private equity in dental versus looking at the S&P, you would see an $85,000 difference. Meaning, if you got all your money back, if you put it 100K in 2019 and got all of it back, whatever it landed at in 2022, you would have gotten around 185K out of the Revere venture capital investment, and you would have received far lower, almost close to what you put in if you were lucky out of the S&P. And private equity is the second best there, and venture capital into other sectors was the third best performer, right? So VC in dental is a strong performing investment modality, and that's largely because of the way in which we source deals and diligence them, as well as how we support them and lead them to growth and exit opportunities.
And that last sentence I want to sort of build on a little bit. The idea, and again, the whole goal of our conversation here today is just to give people more information about what venture capital is, because maybe the people listening are far more sophisticated than I am. But until I met you and started talking, I really didn't quite understand what it was either. And so the life cycle of a venture capital fund involves finding a company that's doing about where do you start looking at companies when they're producing how much or what their revenue is?
Yeah, so we have left our doors open. Revere has between about 800 and 900 companies now in the pipeline. Where we get really interested is their growth, right? When they're reaching 20%, plus month over month, quarter over quarter growth, trailing a minimum of 3 months or to 3 quarters, that would be kind of our minimum depending on the type of business. Then we start to really kind of hone in. Does it mean that we don't look at something before, and think it's a game changer? It does not. Does it mean that we don't look at later stage companies who are, already at significantly higher levels of revenue? We do look at them too, right? But it's really that growth. We want to come in around the inflection point, if not even a little bit prior to the inflection point, with good intel, good data to show us that they are there.
Yeah, I mean, the fact that you just don't jump after everybody. You said you have 800 to 900 companies who are interested in you acquiring or working with them, which means also, by the way, not only do you give money, but do you get involved in helping with management as well?
Yeah, so we're very founder friendly. The startup founders manage the company. We do not take a controlling stake. We consider ourselves a strategic minority investor, right? We come in that regard, and then we do really support them. So a couple of ways that we do that, we pair them with what we call our board team. So somebody who's on the board or board observer or advisor who's working one-to-one with them, providing value. We have an analyst team paired one-to-one with them, tracking their quarterly reporting and helping them get ahead of opportunities as well as risks. And then we have an internal product called Ecosystem. It gives them access to some 50 plus key vendor relationships inside of dentistry that are either free or highly discounted for them. And then we also work with our corporate services funnel. These are big corporates in dentistry, manufacturers, distributors, insurers, DSOs, who are looking for opportunities to grow companies, who are looking for opportunities to acquire companies, and we pair them one-to-one, right? So we have a pretty good idea once we've invested in a company, exactly how we're going to help to grow it and exactly how we're going to help to exit it, right? Now, does it all always go according to plan? No. That's why we have options. We have a deep bench of opportunities here to be able to support those pivots that the company may make as they're chasing opportunities down. But we do really have a good idea and a good way to grow and scale that company. So back to kind of a previous point you made, Glenn, investing in a fund versus investing by yourself directly into a company. First of all, you get the diversification of being invested in multiple companies at one time. Second of all, you get the whole team and machinery of Revere behind you, right? The fact that we're looking in comparison shopping across for every startup in every subcategory, we're looking at 10, 24 different options, right? We're going 26 points of diligence on each one of those. We're investing under VC terms, which tend to be the best on the cap table. And then we're supporting them with this deep bench of resources to be able to see them succeed, right? So it's very much a risk mitigated way of investing compared to just, say, investing directly into a startup you might find yourself.
Right. So you have 800 to 900 companies interested. How many companies do you actually invest in?
We've invested in 35 companies to date. So we invested right around 4% of them. We're pretty selective.
And what's the typical lifespan? I know you said 3 to 5, 4 to 6, but in your experience, you've been doing it for 3.5 years, I think you said. How many companies so far have exited?
Yeah, so we have one company exit below our belt in under 3 years. And now we're expecting another 2, possibly 3 to land this year. This is highly unusual, right? You typically don't see a lot of exits occur until after the 5-year point in a venture capital fund. And we've already been entertaining a number of offers. Of those that we have that we're expecting, there are also another about 8 or 9 that have received acquisition offers that the startups have actively turned down because they believe they can be even bigger. And these are fair offers, right? I'm not talking about, a company throwing across the bow some ridiculous number, right? These are fair offers, right? So one in the books, 2 or 3 expected to hit this year, another 8 or 9 reasonable offers that have been made. I mean, this is a lot of traction and activity for a fund at our age.
It's awesome. And so one of the metrics you use, I mean, let's not say one of the metrics, the metric you use the most to evaluate at any given moment how you're doing is what? What is the internal metric that you like to use to measure? Because again, except for the one company that's exited, right? No money gets paid out until something exits. And so how do you know how your growth is going?
That's right. So our performance as a fund is really heavily based on how the portfolio companies themselves perform, right? Just like a hospitalist or primary care physician might look at a little dashboard of vitals. If you come into their ER, right, they're looking at definitely your heart rate, your pulse, your temperature. We do the same thing, right? We have a handful of very important vitals that we look at. Probably, I'd argue, the most important is this IRR, or internal rate of return. Right. And so what this is measuring is largely the change in valuation of the companies. We measure and mark our books on a quarterly basis. So now you may ask yourself, does every company in the portfolio change its valuation quarterly? Of course not. Right. So while that is the primary metric, that when they have a new round or have a new valuation done, that we are marking those most heavily weighted, we also mark their weight in growth, right? And we measure that largely in terms of revenue. So we are quarter to quarter making sure that we are tracking both positive, neutral, and negative changes in their valuations and or in their revenue growth in order to measure the performance of that portfolio. So we have a typical fund, VC fund, will sit at about 20 to 25% IRR. This is general tech, health tech, right? Revere sits on average between 25 and 35%. And speaking openly and candidly with this audience, Glenn, we are typically between 30 and 35%, right?
That's IRR.
That's IRR. Our highest ever is 39.9%.
So IRR is an internal rate of return, correct?
That's right.
So what does that really mean? And again, if it means that, this year, it's based on a quarter, this quarter we grew at 35%, is that an appropriate way of saying it? Or does IRR mean something different?
Yeah, it really means that the value of the portfolio companies, the assets, the main assets of the venture capital firm have grown by that percentage. Right. So over the past 3 months, because we measure it quarterly, we're reporting that level of growth in value. Right. So it's the most direct measure of the change in value of an investor's money. Does it one for one mean that if you put your dollar in January and you try to pull it out at the end of, you can't pull it out, right? But if you were theoretically able to pull it out at the end of March, would then have turned into $140, right? It does not one for one mean that. And of course, you can't pull it out like a rotating carousel like that. But that is the closest metric that represents the change in value of those assets.
Is IRR in many ways a speculative number because you're guessing what their worth is? How do you put a real objective number on IRR versus, a company hasn't sold yet? Is it just based on their revenue and how much they've made, worked into a formula that figures out if they've done this much in this field, this is what they're worth now?
Yeah, so it's actually fairly objective and fairly, I would for sure say fairly analytical. Right, the highest weighted contributor to this IRR are their valuations. Right, so this is when a new company, an institutional investor, is coming and putting a formal valuation on the company, right, or they're going and getting a 409A valuation. They are getting a formal valuation by a third party, right, and that is the highest contributor to this IRR. Right, so those are objective and analytical. In the absence of that, because again, they do not change value every single quarter, right? In the absence of that, we internally will do the same type of calculation that a third party will use to arrive at that valuation number. And we will use the same inputs, their revenue growth and et cetera, as well as their expenses and their profit. to calculate that number. It will just be internally done instead of done by an external third party. So it's quite objective and it's quite analytical. But the difference maker is that what the market will bear is only ever known when it goes to market, right? And this is fairly similar to a dental practice and PE, right? When you bring a group to market, you may get a different number, right? And given that the markets have vastly improved since the 2020, black swan multiple sigma event that we all experienced of COVID, right? Then, typically the returns in this space are really, really good, right? On the private equity side, and we've talked a lot for many years, it stayed pretty constant at 6 to 8 turns on EBITDA, right? It has climbed to Houlihan Lokey, a major investment bank, reporting 13 to 14 turns, and the highest being Affordable Care, I believe, at 18 to 19 turns, right? So you're talking about pretty substantiated numbers there on the PE side. It's actually pretty similar on the venture capital side. We have further research to show that as well. But it is really the fact that when you take venture capital assets to market, you have kind of these internal rates, which tend to be, more conservative measures. And the market, in a good market environment, tends to bear even bigger numbers, right? So in other words, dentistry, both its private equity and its venture capital, are definitely trending to the up and to the right. And it's really, advisable to be diversified within your investments and being conscious of, especially if you're in the field, is all of your money going out of the field or is some of it going back into the field?
So when someone listening to this, as we start to wind this down, someone here listening goes to their family or friend who's in the financial industry, who's maybe a financial planner, and says, I've got this great idea. I want to invest in Revere Partners, this venture capital fund. And their friend invariably is going to say back to them, oh, dude, venture capital is really risky. I mean, which historically is true, right? Venture capital tends to be on the riskier side. And again, you're not a financial planner, nor am I. And in full disclosure, I am an investor in Revere Partners. I love it. I'm happy to be a part of it. I'm sure the future will tell us how well it does. I hope it does great. And so do you. But on a scale of 1 to 10, in your opinion, with 1 being, I don't know, the riskiest investment you could possibly get, and 10 being, treasury bond, T-bills, is something super conservative with a low return. Where would you say you feel traditional venture capital would fall on that? And where do you feel Revere falls on that? I know it's a tough question.
Yeah, it is a tough question. And look, I look at it from my own personal perspective, right? And diversifying my own assets, right? So I try to put myself in the shoes of an investor, as I am one, right? So, historically, you're right. Venture capital was considered to be a risky investment, right? But when we say historically, we're really meaning, right, over the last 20 years, and then, before those last 20 years. In the last 20 years, we've had the 2008 market crash. We've had, COVID. We've seen the real estate market crash. We've seen the cryptocurrency markets crash, right? So, I'll advise everybody, some of the former investment styles are not necessarily the safety blanket, that you think that they are. And, depending on who's giving you advice, one question for your CFA, your CPA, or whoever you're relying on for advice is, how familiar are you with alternative investment and asset classes, right? Because they may know a few asset classes really well, right? But they may not know something like VC at all, right? And if they're just stuck on historical knowledge, we have to be cognizant of, kind of who's giving us advice. And I've run into that a number of times in the industry. And Revere has spent a lot of resources also on trying to work with a lot of our financial advisors and planners that are in the space. So yeah, the other thing is you're investing in a fund with a really tight mandate or thesis. And that's another important differentiator. It's when we also say, VC is risky, we're typically talking about investing into a fund that has a very general thesis, right? Tech, software, marketplaces, B2B, right? Consumer packaged goods. These are vast, vast, vast areas, right? That you're competing against dozens, sometimes often hundreds of other VC funds. And you have, numbers of companies way beyond the pipeline size we see. It's very tough to make a good bet, right? We all hear the success stories of Uber and Canva and some of these other major and success stories, guys. Those are ones of millions, right?
Right.
Ones of millions that die on big hills with lots of VCs invested behind them that just fizzled out, right? So the fact that we have a tight and focused mandate with people in the field that know how this field performs, and the fact that the field itself has proven itself to perform well even during difficult times, these things take the Revere, which is a venture capital fund with a focused thesis in a space that provides well, right? It takes it to a level that is outsized from what your typical VC investment is. It is a whole lot less risky, right, than VC of years ago and VC into general firms, right, and VC into big spaces. So you have to really think about what you're investing in, right? Because generally speaking, if you can't see it end to end, if you can't wrap your mind around how big are they sourcing from, how are they going to help it, how are they going to be able to exit it, if you can't really see that pathway, right, that's where the risk starts to be introduced. But here, I think we can adequately show, folks exactly where we're sourcing from, exactly how we choose those investments, and how we grow and exit them to names that we've all seen and heard before, and clear metrics that I hope I've been able to show you here on the call.
Yeah, I agree with you. Everything you said is perfect. I mean, it wouldn't be like, any VC has ever invested in a company that wasn't crystal clear. WeWorks, sorry. Did I say WeWorks? I didn't mean that out loud. But at the end of the day, like I said, I believe in your mission. I'm an investor. If people want, I know you're going to be at Summit, Orthopreneurs Summit, which will be great. And we'll certainly talk more about that as Summit starts getting closer. If someone wants to reach out to you or somebody at Revere to learn more about it, how can they get a hold of you guys?
Yeah, definitely come see us at the Summit. It's probably our favorite event of the year in dental. We'll have there Jill and Emmy. Emmy's our head of fundraising. Jill is our head of investor relations. If you want to reach me, it's Jeremy at reverepartnersvc.com. And all of us, it's just our first name, Emmy, IMMI, or Jill, JILL, at reverepartnersvc.com.
So if someone doesn't want to wait until Summit and says, hey, this is interesting. I have money to invest. I'm in stock market. I'm in mutual funds. I'm in commercial real estate. I'm in private. I want to be in venture capital. I want to be in venture capital related to dental and orthodontic and companies that I can touch and understand. It's not some weird software platform that someone's creating that I'm taking on, right? I've had a chance to be on some calls and listen to some of the products and I understand what they're doing well, and I understand what maybe they're not going to be doing well, why you don't want to be a part of it. And so I would encourage everybody out there to please reach out and at least learn a little bit more about it. Ask a lot of questions. I will leave with this. I was recently speaking to somebody about private equity. And I know private equity and venture capital are different, but it's private equity in the healthcare space, stuff we can touch, know, we understand it, it makes sense. And I started talking to other people in private equity, same sort of thing, and unrelated to orthodontic, OSOs, unrelated to that. I said, once you see these kinds of investments, why do you invest in stocks and bonds and mutual funds and the answer from every one of them to a person, and I'm not going to ask you to answer because I don't want to put you on the spot. Their answers to me were, A, I'm going to bet on myself before I bet on some manager I've never met before, heard. B, I'm going to bet on a company that I know that their thesis is what it is, and that not another company that might have some other interests in mind that I have no ability to wrap my head around. And last but not least, why the answer one person gave me, which was the best one I heard, and we'll end with this. He runs a decent sized private equity fund and said, if I got on a shareholder call and I said, hey guys, the market's down 18%, but we're only down 8%, he said, I'd lose my job. I'd be thrown out of business. And he goes, and how many times have people sat on the phone with their financial planner or with somebody who's running something at some institutional organization, and they go, hey, great news for you, Glenn. The market's down 20%, but you're only down 10%. This was great investing on our behalf. And I'll spare you the need to have to answer that one, Jeremy. But once you get into the world of venture capital, once you get into the world of private equity, there's a different metric by which you guys run. And looking at your investors and going, hey, it was down 20%, we're only down 10%, is not really part of the lexicon of the VC and the private equity world. Would you agree with that?
That's right. We have to be at positive returns. There's no negative or less negative returns in this world. We would all lose our jobs. And I guess I'll end, Glenn, with a statement, which is, I heard from, a gentleman who sits on a board with me. He runs a very, very large DSO. And in that meeting, said, I thought a very good comment, which is, we can do almost anything, but we cannot do everything. Right? Meaning we're really focused, and we need to be really focused in what we do in order to do what we do well. Right? And so we have to pick and choose from a lot of good opportunities, which are the best ones. And that is where we place the emphasis. That's where we place the pressure. It's where we apply the resources in what we do best.
Well, with that, I want to say thank you from the bottom of my heart for being here today, Jeremy. Thank you for all the good work you're doing. Again, if anybody wants to reach out, it's their first name. It's either Jeremy, Imi, or Jill at Revere Partners VC. Is that it? ReverePartnersVC.com. And can't wait to see you at Summit, my friend, and pick your brain on this stuff a little bit more. We've got several stressors in our life. We've got a great profession, but we've got to deal with overhead. We've got to deal with productivity. We got to deal with team members that are outside of our control sometimes. And the great news is all of these issues are addressed in depth in this year's curriculum at Orthopreneurs Summit. So please go to opsummit2023.com, sign up for the meeting that's almost sold out, that everybody's going to be talking about, that you really need to be at to be your best practice with the lowest stress and highest profitability. opsummit2023.com. Please join me there so that I can take care of you even better than you take care of your patients.